everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Actually, a lot of our clients came to us lately and asked us how are we, I have some money setting aside, but it seems like the market is going down in Canada. And how am I supposed to spend this $100,000 that I saved up? Where should I invest? I mean, we're always trying to provide the best insight, and which leads to today's guest, Andrew Kim from Share. You guys don't need to worry about Share yet. We're going to do a mini series about what Share does, but Andrew has been investing in the States for a number of years now, and he lives here in Ontario. He chooses to invest in the States. So I figure what's best to talk about the investment in the US than having someone who has done it to share his journey with us. So welcome, Andrew.
Well, thanks for having me.
Yeah, so tell us a little bit about yourself.
Yeah, so professionally, I've been in the technology world, in the consumer space, but always had a passion for real estate. So between my professional career, trying to parse time in real estate, build wealth, you've been always so busy. So in the consumer space of tech, my own companies, between my own startups and high growth divisions of large enterprises.
Oh, so you're my people. You're also an entrepreneur. Okay. So, but then how do you, so you are still in that tech space?
Yes, correct. Yeah.
What do you do?
Yeah, so I was looking to build another technology company.
Second one.
Second one. Pandemic hit, and I didn't know how long I'd be at home stuck with my kids, and needed to pad my passive income and new real estate. I'd already built a bit of a portfolio and said I'm going to deploy more capital, and then was finding it very difficult to do it in a very efficient way. So that's what spawned my current venture, which is Share. So technology meets real estate investing, and that's what I'm focused on now.
Okay, so you said that you started by investing your previous earned venture into real estate.
Correct.
Where were those properties?
Yeah, so my first foray into the US real estate market was in Florida, then upstate New York, then followed by Georgia, Atlanta, Georgia, and Texas.
Okay, cool. But what leads you to buying in the US instead of locally in Ontario?
Yeah, so I used to buy in Ontario, Ajax and Barrie, back in like 2010 when you could get a house for like $350,000.
Yes, those are good days.
Yeah. And then I spent some time living in the US and was introduced to some Florida real estate. And the numbers were just jaw-dropping, and I didn't really believe it. And they had this one additional line item in there that was property management, and I was still cash flow positive. So was introduced to the St. Petersburg area of Florida, where you could get a house for $90,000 to $100,000 and get anywhere north of like 9-10% sort of cash yields.
So you're saying that you bought properties in Durham region and for $350,000, and were you able to cash flow?
I didn't follow it tightly. Like, I think after all said and done, once I've renovated and tenanted, it was cash flowing, but I was self-managing, and that was not fun.
Yeah. Why? I wonder why.
Well, first, like, you couldn't find a property. I couldn't put the effort in to kind of makeshift my own property management company and find a new one. And then I couldn't afford a property management company with the sort of rent roll that I was collecting.
So what I'm hearing is that you were self-managing. It is at least at break-even point. So
Yes.
that's the good news. It's just that you can't sustainably grow that portfolio because it wasn't generating enough cash flow.
Correct. Yeah.
Yeah. So did you ultimately exit your Ontario portfolio?
Yes, I did. Yeah.
And then you switch all your capital to the States?
100%.
So how many properties do you have? You can give us a range.
Yeah, I'm in the 20 range.
Oh, okay.
Yeah.
And then they are all across different states?
Yes, those 4 states.
So then how do you manage those 4 states, like all these properties?
With various property management companies, and then I originally was sort of managing them, and now with Share, I'm kind of even further back.
Okay. So how did you find those properties?
So I was introduced to my accountant, who is now my business partner. She's a CPA on both sides of the border, and she had built a real estate portfolio herself in the U.S. She partnered with a local agent who also happened to have a property management company. So it was all within that individual's network.
Yeah.
And then they introduced me to both Florida and then New York. And then that kind of got my palate wet, and I started doing more research and finding other ways to kind of acquire properties in other states.
Okay, so a lot of our clients in Canada anyway, they qualify for financing on their own, right? Pretty much a lot of our clients qualify for financing using their own personal income. And then so at some point, you're going to hit the wall in terms of credit limit because you only have so much income. Even if you're making $250,000, you can still hit the wall pretty quickly given the price in Ontario as well. So how's the financing situation in the States? Because like for us, we're Canadians. If we want to explore the options, we don't have a local social insurance number.
Right. Yeah. So we can typically what you would do is set up some sort of U.S. entity and then borrow using that U.S. entity. And there are a lot of investment loans, investor-friendly loans. One in particular called a DSCR loan, a debt service cover ratio loan, that underwrites the house, not the borrower. So you can get sort of a written approval within 48 hours. They typically look at, what is your proposed rent rate? They'll do their independent research saying, okay, yeah, we can achieve this $1,500 rent. Then they ask for the hard costs like your utilities, property tax, property management, and insurance. And if it can cover that, they'll lend it to you.
Oh, okay. Do they need personal guarantee?
No, there's typically no personal guarantee. They just want to make sure that there's some sort of a human trailing behind these entities, but you don't have to have a credit score put forward.
So you mean like I could have a 500 credit score and still get something in the States?
Yes. They look at the house versus the borrower, and experience is usually plays an additional sort of cherry on top.
So it's kind of like they look at it as from business perspective, like really lending it as a business loan.
Correct. I believe I'm not. Oddly, I'm not as versed in real estate investing in Canada as I am in the U.S., but from what I understand, it's very close to the commercial loans in Canada.
Yes, absolutely. I've got a couple of those, and they really look at the income of the business and then really do their cash flow, DSCR or discounted cash flow, or whatever cash flow model that they look at, and they do that calculation.
Yeah.
And then so typically in Canada anyway, with the loan that I'm familiar with, they're only lending up to 65% loan to value. And a lot of the time it doesn't even make sense because they wouldn't even allow us to, based on the cash flow, discounted cash flow model, like based on your rent and debt servicing ratio, it doesn't even make sense to go with a commercial loan because the rent is not high enough for the mortgage payment to justify that the property price. How's that in the States when it comes down to borrowing using these type of loan?
Yeah, so again, each lender, there's a million of these lenders. They all have certain ratios, sweet spots. Obviously, if you can cover it to like 1.2, then you're probably really good. But there are some lenders that will go into the negative territory. That just means that your interest rate's going to be a bit higher.
Okay. So then, or maybe I should rephrase my question. The question is, like here, we use a commercial loan, we plug in the formula, maybe the property is at $800,000, $900,000, and at the end of the day, the commercial loan is only going to lend me $400,000 or $300,000 because of the rent.
Okay.
So how's it in the States in comparison?
Yeah, so they would still, as a foreign national, as a Canadian, they will lend up to a certain amount. Usually in the normal markets, 25, but in this market, potentially 30 to 35%, or let's say 65 loan to value, up to 75 loan to value. Again, sort of, and I think I'm understanding the question correctly, is if the ratio is negative, then they would obviously claw down. If you want to go in the negative, again, they'll just hike the interest rate and they might lend to you.
Okay. I guess my question is more about your experience. Have you ever gone into that type of situation like, hey, I really thought that I could refinance it to like 80% of $800,000, but I'm not able to get it because of this loan? Or maybe your situation is slightly different because the state price is so much lower in relation to the rent. So that's more what I'm
Yeah,
asking.
I've never been able to not get a refinancing. There's always somebody that I can actually unlock my equity, and I don't typically ever go into negative. Well, I don't ever go into the negative cash flow area.
So then that means your, I guess your pricing. I guess if you walk us through one of the examples, then that would be easier.
Sure.
Because if your pricing is $200,000 fair market value and your rent is 2,000, then yes, you probably would be easily able to refinance.
Yeah.
Yeah. So give us an example.
Yeah, so the way I look at it, there's anywhere from and I'll use cap rate. Is it okay with cap rate?
Yeah, yeah.
Okay, so do we need to break down the formula of cap rate, or are we
Yes,
good?
yes.
Okay, so cap rate, we look at sort of the price point of the house to the returns, sort of after your operating expenses as a percentage. So that's kind of how we look at the returns. And then after the cap rate comes your sort of financing expenses after that. So the way I'll look at it is typically I'll go after nothing lower than a 4% cap rate, and a 4% cap rate typically means it's a very good appreciating asset in a very good area that has, let's call it 5 to 6 plus on sort of a down market year-over-year appreciation. And then you've got higher cash flowing homes where it will be 6, 7, 8+% cap rates. So that's how I kind of look at the different homes. Those homes are lower on price point, typically around $150,000 homes, and more modest appreciation. Let's call it around the 3%, 2 to 3% annual appreciation. So I look at those and then I say, well, what's the financing rate? And I kind of find the right mix of cash and debt to finance that home.
Absolutely. This sounded more like operating a real business. What business owners actually look at when they invest when they do operate a rental business, rather than like, hey, I'm owning this rental property and buying it at $800,000 and negative cash flowing $2,000 a month. So yeah. So you're trying to or can I say that in your portfolio of 10 to 20 properties that you're not negative cash flowing?
No, definitely not. No.
Okay.
Yeah, definitely not. I mean, if it is, I would bundle it as a portfolio. So I would go refinance some of my high cash flow homes and then go and buy like a nice higher appreciating asset. For example, like I just refinanced a bunch of my, let's call it 9 cap rate homes to unlock and buy some 4 cap rate homes because I've got a good price on these 4 caps. So as a whole, still cash flow positive, but on a per individual unit, the 4 might be a bit negative in this sort of interest rate environment, but no, it's cash flow positive only for me.
Okay, cool. Now I wanted to ask this final question. This is a big one. You just mentioned your 9 cap rate home. Can you give me one example of when you buy one of them? This is like really not prepared, I'm sorry.
Yeah.
And how, like what price point, just one of them?
Yeah, so the 9 cap rate homes are typically your 70K to 80K home.
70K to 80K?
Yeah.
Okay.
We don't advise beginners to start there because you need to stomach some hardships before you find the right one, the right house, the right neighborhood, and then the tenant profile of that neighborhood. But when things go smoothly, they go real smoothly.
So 90K US dollars, but still 90K home. How much rent can you get?
Yeah, I mean, backing into that, you're probably looking around 900 plus, or even to 1,200 at some points.
What?
Yeah.
That's possible?
Yes. Yeah.
Okay, so does that cover utilities and everything?
Yeah, usually the tenant pays all of the utilities.
So it only covers you only need to pay property tax, insurance, mortgage, obviously, and property management.
Correct.
So then, so give me the example. One of them. What year did you buy it?
Okay. Yeah, so those are ones I bought a long time ago, probably around the 2012, 2013.
How much was that?
At that time, they were probably like 50.
50,000.
Yeah.
Oh, okay. So now it's 90,000.
I would say approximately like in the 80s to 90.
Yeah. Okay.
They're not aggressive appreciating assets, but when they cash flow, they cash flow.
That's awesome. Yeah, good to know. Good example. What about the 4 cap home that you just bought?
Yeah, so those ones, the price point was probably in the like mid 300s, and again probably less than 20 years old. Nice neighborhood, 3 bed, 2 bath, about 1,500 square feet. Those typically, like I'm banking on those to be 6%
Yeah.
year over year,
Yeah.
even though historically those zip codes have performed a lot better, but
Yeah.
trying to be modest on or
Yeah.
conservative on my
So how
assumptions.
much rent can you get from the 300,000?
Yeah, so those ones you're probably looking at mid 2000s. You can even probably push high 2000s.
Okay, okay.
Yeah.
Good information.
Yeah.
Well, like I learned a lot from having this conversation with Andrew. For sure, we're going to look into the $70,000 to $90,000 range properties now, because that I can afford immediately, without liquidating anything. Yeah. So thank you so much. If
Yeah, thanks for
anyone
having me.
wants to find out about Share, I have the link below. We will share that information as well. We're going to record a bunch of videos for you guys to get a better understanding of what Share does. And we're going to host a webinar, right?
Yep.
Yeah, so we have a day tentatively selected in February. Once we find out more information about the webinar, we'll let you know as well. Make sure you sign up to realestatetextips.ca, and then you'll be the first to get the invite. So thank you.
Oh, thanks for having me.
Yeah.
All right.